Hope everyone had a great week. It was very, very unboring, that's for sure. We had some great moves and everything. Tesla and AVGO going bananas, sort of the last of the parabolic moves that we saw before everything started to kind of turn down. Just a reminder, everyone, of the disclaimer. So, that anything we talk about today is for educational, entertainment, and information purposes only. We actually did see volatility get a little bit excited ahead of the FOMC, which you would expect, but really volatility wasn't high. I think the S&P was pricing in, I don't know, a 50 or 60 point basis point move, and we moved almost 3%. So that is a massive underpricing of that move on Wednesday. So really threw the whole market for a loop. In my weekend video, I talked about how if we could get below 6,000, I talked about this on the option pitch show as well. If we could get below 6,000, that really doesn't bode well. So we got into that air pocket that a lot of people have been talking about. I kind of thought we'd stay between 6 and 6,100 for the balance of the week, which is the biggest expiry of all time. And we didn't, right? It was enough of a spark. And sometimes a big enough move, that's why we always have to take gamma and those kinds of things with a grain of salt, because a big enough organic move, by organic, I mean just underlying flow, right? If enough people are selling, it's going to blast through put walls, call walls to the upside. It's going to blast through anything, right? So these things are great until they don't really work. But when they do blast through a lot of gamma, you can almost bet that that is a sign that there is a significant amount of stock for sale. And sure enough, we got down, we bounced around 600 very briefly after FOMC, and then just kind of the trap door opened and the market just kind of flushed. And we had that extra flush this morning. I did a video yesterday talking about um, how I'm watching volatility in the coin complex names. I was looking for that skew to really, really kick up in something like MSTR. MSTR traded at $300 in the pre-market. Look at that, back to 364 by the end of the day. What an unbelievable move. I mean, this thing is a mover. And the volatility dropped. So isn't that interesting? We got down to 300. We rallied, what is that? Another 20% from there, right? From 300, we rallied over 20% back to 364, and we actually had volatility drop. So the physics of these particular products from a vol standpoint has actually almost flipped on its head a little bit, because typically what we've seen is volatility rise with these names, right? Because they kind of the volatility kind of incorporates worry that these things can really run for an sort of a huge amount to the upside, and volatility doesn't, is always scared of it. It's almost like gold. It's like GMC or GME, things like that kind of have this ability to kind of go bananas to the upside, go parabolic. So even though we went up, so we went down a little bit, volatility actually rose. So we got to the point where from 400 to about 370, 365, volatility did what it was supposed to do, which was drop a little bit. But then once it broke through those lows of the last few weeks, once we broke through 360, that's when volatility started to price in something unusual. So remember, volatility can kind of act a certain way within a certain range, but when we break out of a range, volatility often takes on a different kind of texture. And so volatility started to kind of spike a little bit down towards 300. And I was looking for that skew to kick up. I didn't get it, right? Maybe if we'd opened down in that sort of 3780 to 3800 level in the S&P, maybe 378 on the SPY, which is where we were trading pre-market. If we'd opened down there and MSTR opened at 300, I think we would have gotten that skew I was looking for, that kind of panic bid to the downside. And that might have been the signal that I was looking for from my other video. But, it wasn't to be, because I think a lot of it happened pre-market. And then we started to recover. A little bit of data came out. We started to recover a little bit. Maybe people sort of looking towards that Santa rally that might ultimately come next week, right? My gut feeling is, in a lower liquidity environment with people kind of leaving, we probably get back into a little bit of a march up a march up pattern. So VIX 25 is where I think anything can happen. We're back down into the 18s. I wonder how low we can actually get though, given what's coming up, right? So if we sort of look beyond the next 10 days, we get into January, we get into this new calendar year, we get into reshuffling of portfolios for taxation reasons, right? We're going to have some selling now and crappy names. We're going to have some people waiting to sell their winners until the new year, so they don't have to pay taxes this year. So you're going to have a little bit of reshuffling of paperwork on the desks, and then we kind of look towards that inauguration. And now there's sort of a little bit of this idea that Trump isn't 100% positive for markets. We have some questions like, and one of the ways I saw somebody explain this, I thought it was very interesting. They said the tariffs and the immigration issues, in terms of expelling people from the country, those are more immediately inflationary to the extent that we get inflation data, right? This is sort of more front loaded. So potential negatives are more front loaded because tariffs and the immigration thing are an executive order, right? Trump can just snap his fingers and certain things can start to happen rather quickly. The taxation thing that is really a benefit from Trump is going to take a lot more time. So we sort of front load some negatives. Now I'm just kind of cherry picking three things. There's a lot more to Trump 2.0 than that. But, and we'll see what the market kind of focuses on. But I think there's going to be this certain level of uncertainty. I don't think the inauguration itself is a big issue, but the meaning of this sort of big sea change that we've seen out there, in addition to Powell's big pivot on Wednesday, which of course was just, back in August, we were all kind of going, what are you talking about? Everything looks fantastic. Economy's great. Everyone feels rich. If you can get a 10 or 20% sell off in the S&P, yeah, then you have a reversal of the wealth effect. But remember, spending and a lot of growth, a lot of the economic benefit comes from people just feeling rich. So there's just so much at stake in the stock market, right? And that's another sort of thing I talked about, volatility clustering in a tweet this morning, and I said we are really in this world where we have volatility clustering. Either it's either all heck's breaking loose or everything's perfectly fine. And part of that is so many of these products that exist out there, these vol targeting products, which again I've explained a few times. These are funds that when volatility drops, they need to buy, and when volatility rises, they all have slightly different mandates, right? So it doesn't necessarily happen right away, or it's different for certain funds. But basically, when volatility rises, they need to sell the market, and and that exacerbates the selling, right? So there are these things going on, including ETF rebalances, right? The leveraged ETFs, the inverse ETFs, massive, massive. I showed you guys these charts of AUM in these products, just like exploding to the skies. There's so much of this stuff going on, CTA buying that need to buy and sell. You've got just a lot of stuff going on behind the scenes on the derivative side of things, and synthetic sort of short gamma from these ETFs and things like that really move markets, right? So this isn't your dad's market anymore. This is a new kind of market where these things have an effect, but the effect is an effect of clustering. Right. So what we're talking about here is things that can kind of keep when volatility is low, and when that becomes sort of it becomes a self-fulfilling kind of narrative, because when volatility is low, it has every reason to go lower and lower because of these things that buy when volatility is low, which creates lower volatility, which makes them buy more, which creates lower volatility, which makes them buy more. Right. So and the rebalancing becomes less pronounced, right? But when things unravel the other way, this sort of volatility begets volatility, which is a phrase I've been using for 20 years. It can sort of snowball effect down the hill and get bigger and bigger and bigger. So what does that mean? It means there's less of kind of a middle ground, right? There could be a volatility echo, right? You don't go to VIX 65 without it sort of taking its time a little bit, although we've seen reversions on the VIX faster than ever in history. But still, we are really in a time in markets where you either have kind of nothing really going on or the potential for all heck breaking loose. And it's sort of, I call that vol clustering. It clusters at low levels or it clusters at a high level. It doesn't seem to stay at high levels for very long, as we've seen this year, but it has this potential to be either one or the other, and there's sort of no middle ground. That makes some strategies kind of interesting in the VIX and VIX products because you can sort of pick that middle ground where we're not going to really spend much time, right? Either we're going to stay down and you sort of play that short volatility benefit, or that edge that you have, that alpha from short volatility, which can really persist, or you combine that with sort of explosion protection in those kinds of products. That can be very powerful. You're going to make all the time, and then when things get a little scary, they don't get a little scary, they get a lot scary. So you get this explosive effect from that protection. Again, we saw that this week, right? We talked about it in a couple of my shows. I talked about it, in a couple of shows where I said, listen, this is, there's a beta to the VIX that is really, really, the VIX is got this sort of, we talked about it a couple months ago, 99th percentile in terms of beta to S&P moves. So the VIX is very expressive, very, very quickly when things start to unravel. So, and we've had years where it isn't very reactive, right? It isn't the right place to be necessarily for protection. I suspect that it's going to remain a good place to be for protection because oftentimes the VIX is outperforming downside realized movement in the S&P, right? It's kind of, think of that as you're getting a bigger bang for your buck from the VIX, and if you're trading those products, the underlying futures, you're getting a real good bang for your buck versus the market that might only sell off 3%, but boy, the VIX goes bananas. So you're getting this nice beta from those kinds of products. I'm not saying that's going to continue, but I suspect it probably will be, and you can sort of see it developing. In my video last week, and I showed you that really steep call skew, which showed kind of a level of fear, either dealers pulling back and going, I can't sell this any lower, I'm going to have to, I'm selling too much, I'm too short. We did see some data leading us to believe that they are kind of short gamma up there. So sure enough, that's what happens. The thing, I mean, it went from 15 to 27 like it was nothing, right? Decent sell-off in the market. I'm not saying it was insignificant, but boy, did that VIX just kind of go from, that escalated quickly, right? So this is our new world that we're in. So I think you have to be really aware of this as an option trader, as an option seller, as an option buyer, as a participant in markets in general. So hopefully that gives you a little bit of my overview. I always like to give you a bit about what I see in volatility markets because I live them and I enjoy this part of it. So I hope you learned a little bit something today and have an awesome weekend. I'm going to be around a little bit during the holidays. So I'm going to be in and out. I'll probably do a video or two. And but if I don't see you, all the best. Happy holidays to everybody and all the best health, wealth in the new year. Let's keep it going. It's going to be awesome. We're going to have some volatility. Let's take advantage of it in a smart way though, right? A very smart way. I had my free webinar last night and I really kind of showed people, listen, you can do this, but very, very smartly because avoiding stepping in the big piles of doo-doo is as important as taking advantage of good setups, good trades, good closes, right? It all makes sense. So check out my information in the description below. If you want to check us out, check out the community, check out some of the products that I offer, and all the best. We'll see you in the next video.